Today, I am sharing the portfolio strategy I set up for my wife in her TFSA and RRSP using just 4 ETFs that can give you global diversification while maxing your tax efficiency. This portfolio has delivered a weighted average 19.2% return over the past year, 11.8% annually over the last 10 years. So let's break down each of these ETFs for you right now, starting with VFV, which gets the largest allocation at 70%. This ETF has a current yield of 0.97%, an expense ratio of just 0.09%. Over the past year, it's returned 20.71%. Over the past 10 years, it's delivered 14.71% annually. VFV tracks the S&P 500, giving you exposure to the top 500 US companies, including Apple, Nvidia, Microsoft, Amazon, and Alphabet. I give this 70% of the allocation because the US market has historically been the global growth engine, delivering consistent double-digit returns. And really quick, I've noticed 80% of you who have watched this channel aren't subscribed. Subscribing is an easy way to support this channel for free and help me reach that 10,000 subscriber goal by New Year's. All right. We don't want to put all our eggs into one basket, so 10% goes to XEC, the Emerging Markets ETF. This one has a current yield of 2.17%, an expense ratio of 0.28%. It returned 19.01% this past year, and through its 10-year return, it's more modest, 6.54% annually. XEC tracks emerging markets with 99% of investable market cap, and its top 5 holdings are Taiwan Semiconductor Manufacturing at 7.5%, Tencent Holdings at 4.3%, Alibaba Group at 2.6%, Samsung Electronics at 2.3%, and HDFC Bank at 1.4%. The top 5 countries it invests in are China at 26.6%, India at 20.1%, Taiwan at 17%, South Korea at 9.6%, and Brazil at 4.5%. We include this because emerging markets offer higher growth potential and currency diversification from developed markets, and this is the allocation I'm contributing slightly more to moving forward. Next, another 10% goes to XEF, the Developed International Markets ETF. This one has a current yield of 2.53%, an expense ratio of approximately 0.22%. It had a strong 20.81% return this past year, 7.28% return over the past 10 years. XEF tracks developed markets excluding the US and Canada, giving you exposure to over 1,500 stocks. Its top 5 holdings are ASML Holdings at 1.25%, which is a Dutch semiconductor equipment company, SAP SE at 1.21%, the German software giant, AstraZeneca at 1.06%, the British pharmaceutical company, Nestle at 1.04%, the Swiss consumer goods company, and HSBC Holdings at 0.99%, the British banking giant. This ETF primarily invests in Japan, the United Kingdom, France, Germany, and Switzerland, giving you access to European innovation and established international brands. And finally, 10% goes to XIC, our Canadian market ETF, and this was actually the best performer this past year. It has a current yield of 2.31%, an incredibly low expense ratio of just 0.06%. XIC returned an impressive 24.62% this past year, 11.24% over the past 10 years. It tracks the Canadian market through the 220 largest and most liquid Canadian stocks. Its top 5 holdings are Royal Bank of Canada at 6.9%, Shopify at 5.72%, TD Bank at 4.32%, Enbridge at 3.53%, and Brookfield Corporation at 3.14%. We include this for home country exposure to Canada's resource-heavy economy and strong financial sector. So when you put this all together, the portfolio has a weighted average yield of 1.36%, a 1-year weighted average return of 19.2%, a 10-year weighted average return of 11.8% annually. And these aren't theoretical numbers, these are actual historical returns of this exact portfolio allocation. However, to be conservative in our projections, I'm going to use a 10% annual return for our calculations instead of the historical 11.8. This gives us a safety margin and more realistic expectations going forward. All right, now let's talk about how to implement this strategy in your TFSA versus your RRSP. For your TFSA, use this exact allocation with VFV as your core holdings, since there is a 15% US withholding tax on VFV dividends in your TFSA. This doesn't matter much because VFV's yield is under 1%, so you're mainly getting capital gains, which are completely tax-free. But for your RRSP, here's a key difference. If you have US currency or are willing to do Norbert's Gambit, which is a way of converting currency from Canadian to US dollars, switch VFV to VOO, which is the US listed version. This eliminates the 15% withholding tax on US dividends, thanks to the Canadian US tax treaty for all RRSP investments. If you don't want the currency conversion hassle, VFV is perfectly fine since the withholding tax impact is minimal due to that low yield. Either way, keep the same allocation, 70% VOO or VFE, 10% XEC, 10% XCF, 10% XIC, and over time change those allocations based on your personal preference. Like I mentioned before, I'm leaning a little bit more to XEC this year. So let's look at the power of this portfolio using the conservative TFSA projections. While this portfolio has delivered 11.8% annually over the past 10 years, I'm going to use a conservative 10% annual returns for our projections. That gives us that safety margin that I spoke about and helps set realistic expectations for the future. So here's what happens when you max out your TFSA every year with $7,000 in annual contributions, which works out to $583 monthly, using a conservative 10% annual return. After 10 years, you'll have $119,493. You'll have contributed $70,000 and grown by $49,493. After 20 years, you'll have $442,000 and you'll have contributed $140,000 and grown by $302,000. But here's where it gets really exciting. After 25 years, you'll have $773,986 and you'll have contributed $175,000 and grown by $598,986. And after 30 years, you'll have $1,318,618 and you'll have contributed $210,000 and grown by $1,108,618. And you can calculate this all yourself using the free investment profit calculator in the description and first pinned comment below. All right, so think about that incredible compound growth. After 30 years of contributing just $7,000 annually, your $210,000 in contributions becomes over $1.3 million completely tax-free using conservative projections. That's 6.3 times your money, and every dollar of that grows tax-free in your account. And remember, this is using a conservative 10% when the portfolio has actually averaged 11.8% over that past decade. Now, the reason why I'm emphasizing TFSA contributions is because everyone gets that same $7,000 room regardless of how much money you make, whether you make $40,000 or $400,000 per year. RRSP contribution room, on the other hand, is based on 18% of your earned income up to the annual maximum. So it does vary dramatically between individuals. And also remember, the $7,000 TFSA limit is subject to change based on inflation. The government adjusts it periodically, so we might see an increase in the future years. But now let me tell you why this beats individual stock picking for most investors. As someone who works in the investment industry and thinks about this all day, I do pick individual stocks. So my portfolio setup looks drastically different than my wife's, but that's literally my job. And you can also check out my portfolio in the first link below as well. And if I didn't think about this stuff all day consistently, I would absolutely follow this exact 4 ETF portfolio instead, because most people don't have the time, expertise, or resources to research individual companies, analyze financial statements, and stay on top of market trends 24/7. So if you're working 8 to 10 hours a day and spending time with your family and friends, where do you have time to do research on individual stock picks? That's why you'll almost certainly underperform by picking individual stocks instead of just buying these 4 ETFs. This 4 ETF portfolio gives you exposure to over 4,200 companies globally. VFE gives you 500 companies. XEC gives you over 3,100 companies. XCF gives you exposure to over 1,500 companies. XIC gives you exposure to 220 companies. You get professional management at rock bottom fees with a weighted average expense ratio of just 0.12%. You get automatic global diversification across more than 50 countries, and you get a proven 10-year track record of 11.8% annual returns. And here's the magic of global diversification. Just look at how each region has performed differently this past year. XIC, our Canadian ETF, led the pack with 24.62%, driven by tech companies like Shopify and resource companies. XCF, our developed markets ETF, delivered 20.81% thanks to European recovery and tech innovation. VFV, our US ETF, returned 20.71%, driven by AI boom and mega cap tech companies. And XEC, our emerging markets ETF, delivered 19.01%, which is a solid performance despite geopolitical concerns. By owning all 4, you never have to guess which market will outperform. You automatically capture the best of global growth while reducing single country risk. This is diversification at work. So here are your action steps. First, calculate your TFSA room by logging to your CRA account. Second, choose your ETFs using the 70-10-10-10 allocation I've outlined: VFE, XEC, XEF, XIC. Third, set up automatic investments. $583 monthly works perfectly fine for dollar cost averaging. Fourth, for your RRSP, consider VOO instead of VFV if you can handle currency conversion. Otherwise, VFV is fine. And fifth, stay the course. Don't get tempted by individual stocks or market timing. But remember, this strategy only works if you never withdraw from your TFSA until retirement. Every early withdrawal permanently destroys the tax-free growth potential. So here's the bottom line. You don't need a high income or complex investment knowledge to build serious wealth. This simple 4 ETF portfolio funded with just $7,000 per year that everyone gets has a proven track record to create over $1.3 million in tax-free wealth over 30 years using conservative 10% projected returns and potentially much more if it continues its historical 11.8% performance. It's so good that half my family's portfolio is set up this way. The key is just starting and staying consistent. Whether you're 25 or 45, the principles are the same. Max out your TFSA with this globally diversified portfolio and let the power of compound growth and international markets do the heavy lifting while you focus on earning more income and just living your life. Because these aren't theoretical projections. The portfolio has actually delivered 11.8% annually over the past 10 years. I'm using conservative 10% projections to set realistic expectations, but the upside potential based on historical performance is even greater. So let me know in the comments which of these ETFs you're planning to add to your portfolio, and watch these videos for more investing tips. Bye guys.